Welcome everyone, and thank you for attending today's Alkane Resources Investor Briefing webinar. I'm Nicola Gazzatti of Investor Relations Consultancy Corporate Storytime. Today I'm joined by Alkane's Managing Director, Nick Erner, and Technical Director, Ian Chalmers, following the release of a scoping study for the Boda-Kaiser gold copper deposits at the Northern Morlong Porphyry Project in central West New South Wales. Nick and Ian will be providing us with an investor update, which we will then follow by a Q&A session. So without any further ado, I'm pleased to hand over to Nick and Ian.
Welcome, everyone.
Yeah, good morning.
So today we're going to talk through specifically the Boda-Kaiser Scoping Study, which we've spent pretty much about a year on, predominantly in metallurgical work, obviously drilling out to indicated, wrapping some mine plans around those, and then, of course, pulling all that together and getting capital pricing, particularly of the plant. And we'd like to talk you through all of those and answer any questions. This disclaimer is exactly the same as the one within the scoping study. I encourage you to read it. Clearly, the main point I want you to take out is this is a scoping study, plus or minus roughly 35%, and it's designed to let us make decisions on how to move forward with the project. So these are different things I'm going to talk to you about today, Ian and I. We'll go through a bit of a summary of the project, then we'll dive into the resource and the geology. Just a light touch on that because there's obviously a lot we could talk about it. We'll talk about the mining and processing, go through the capital costs, and I particularly want to outline for you a lot of the infrastructure costs that we have associated with that. We'll go through some of the economics and talk through the assumptions that underpin that, and then we'll talk about what we're going to do going forward. So first, for anyone that's unfamiliar with where this project is located, here's Sydney, and about 4 hours to the northwest, we have Dubbo. Down just off the page is Orange, and here's the Boda-Kaiser project. To the northeast of Wellington, about sort of 20 kilometres by road. These are rail lines. It's well serviced by rail, and there's major power through here as well. So this is very high level of the metrics of the study project. I've just put the 20 and 10 million tonne per annum scenarios. We looked at 3 different scenarios. We looked at if we milled 5 million tonnes a year, what if we milled 10 million tonnes a year, and what if we milled 20 million tonnes per year. This is the high-level summary of the 10 and 20. Clearly, such a large deposit as this lends itself to economies of scale. And what that means is the bigger it is, the better it gets. What we looked at was, could we do a 5 as a sort of company that, one that the size that our company could do quite easily? What we found with that is, sure, the IRR was positive, but at these current gold and copper prices, the return wasn't anywhere near as good as a 10 or a 20. So I'm going to talk a lot more about the 10 and 20 million tonne per annum in this presentation. And if you look, so the headline numbers that we've talked about in our announcement, if you look at the 20 million tonne per annum, the initial project life of mine is 17 years. That's virtually all open cut, and we'll talk a lot about underground mining options going forward. Decent production, quite high over the first 5 years, and we've got a grade profile that we can show you going on. Initial capex, basically $1.8 billion, including contingency. And then it gives a pretty decent all-in sustaining cost. What by-credit basis means if we take the copper, we sell it all, reduce it off the cost base, then the remaining 160,000 ounces of gold would have cost $630 an ounce Australian to produce. So solid NPV, a ratio of about 1 between the NPV and the capital outlaid, and then free cash flow, excluding that capex, of $4.3 billion over the first 10 years. So I think the thing I really want to point out here is this is a very, very simple, large, expensive to build initially, but very, very simple mine and processing facility that we're talking about. We're talking about a large open cut mine that lends itself, and we haven't gone deeply into this, it lends itself to automation and other larger vehicles, things like face shovels and other stuff that we didn't evaluate. So it lends itself to large bulk mining in an open cut environment. There is also potential for a large underground bulk mine resource. We'll talk about how we can examine that further. And the flow sheet is very simple. One of the interesting things is the 20 million tonne per annum scenario is actually 2 10 million tonne per annum trains. And the reason for that is nothing remarkable apart from the fact that with the bond work index and the bore mill sizing, some of the larger bore mills that you get, it ends up being pretty much 10 million tonnes per annum. And so you put two of them and have two trains and you end up with a 20 million tonne per annum. That's how we ended up with that sizing. And so the type of flow sheet that we would see there is a high pressure grinding, bore mill, into flotation, series of flotation, rougher scavenging circuit and cleaner banks. The cleaner con, which contains copper and gold, is pressed and shipped like any other copper concentrate. That contains nearly 90% of the gold. The rest of the 10% of the gold goes into the cleaner tail and is leached on a conventional circuit, just like the one we have at Tomingley, to make gold doré. Good recoveries for an ore body of this size and grade. And as I showed with the location, excellent place to be. So it's a very, very simple operation. So there's not a lot of complexity to it. What there is the economic realities of it and how that we advance those going forward. I think the thing that we really want to stress is, we're a gold mining company and exploration company, but this is a gold and copper resource. Roughly 50% of the revenue, depending how you do prices. In our case, we, for this model, did $15,000 per tonne Australian and $3,500 per ounce Australian. Roughly half the revenue comes from copper and half from gold. It's very well documented about the shortages of copper in the market, and so we're quite encouraged by the fact that the concentrate is of that kind, that concentrate is of that quality. And so we do think that's why we ran with the spot prices. Anybody, analysts, whoever, can put their own forward pricing going forward. But we've got to think, if this mine is being built in 7 to 10 years' time, what is the gold and particularly copper price going to be then? And it's those things that the fact that both of those commodities can be hedged, both of those are needed, gives us a lot of confidence about the future prospects for funding. I'll now throw across to Ian to give us a bit of a summary of the geology and the resource. We've talked about this a fair bit before, but just to give you some of the latest work that we've done and how we came to get an indicated resource. Ian.
Yeah, thanks, Nick. Look, in summary, and I won't get too detailed on the geology, but on the right-hand image, you can see a plan showing the alteration zone of the main Boda and Kaiser alteration zone. And that image is about 3.5 kilometres long and about 700 metres wide at its maximum point. And that alteration was the target from the drilling, the first discovery hole that we made in 2019. And on the back of that discovery, we then embarked upon a program, initially broad space drilling, about 100-metre line spacing. That gave us an indicated resource for both Boda and Kaiser. Recognising the value of that, we knew that we had to come in and close down, so we went down to 50-metre line spacing, and that then produced us with a indicated resource in the core part of the deposit, and that's really what we quote today. So you can see the two deposits are very close together, and when you look at an open pit plan, you'll see that the pits almost merge. But one thing I'd like to say here, well, I've got the image, and the image on the left-hand side is one of these things that people do occasionally is show all of the drilling compressed into one flat plane, and it's quite difficult to do that. But the key things that come out of that are you can see the reds and oranges, which are the nature of the ore resource, what's there in the ground, and how Kaiser is a broader, more open resource, as distinct from Boda, which is focused very much on a vertical sort of extent. And that's really important when you look at the model that we run. We've had two open cuts. We've had one in Boda, one in Kaiser, probably 400 metres deep, another one at Boda about 500 metres deep. But that really is quite high, and particularly when you look at Boda, and you can see a long extension of that going to depth, going down to 1,000 metres vertical depth, which could provide the bulk tonnage underground operation that we're talking about. And again, while we're on this slide, I can point out Boda 2. So Boda 2 and 3, there's mineralisation closer to the surface, which gets caught in a couple of small pits. But the basics of Boda 2 and 3 are deep. So you're looking at something like 800 metres down. There's a number of high-grade intersections down there, and I'll talk perhaps about that later when we're looking about the future. So the next slide, please, Nick. So this is the summary slide of the resource. This is the indicated and inferred using two different cutoff grades, and we used on the basis that would be open pittable to a depth of probably somewhere between 500 and 600 metres, which is the 0.3 gram gold equivalent cutoff, and then below that a 0.4 gold equivalent cutoff for an underground operation. You combine those two together and you get about 800 million tonnes of 0.33 gold and about 0.18 copper. And they've formed the basis of the model that's been run. Again, appreciating that the model that's been run now so far is just open cut. So it really deals with the top section there, around about 500 million tonnes at 0.33132 gold and about 0.18 copper. The graph below, the grade tonnage cutoff grade, again, gives you an idea of the sort of flexibility that we have. So we looked at the 0.3 cutoff and the 0.4 cutoff, but it's possible that over time, if the model detects it or the economics dictate towards it, we can take a 0.5 or a 0.6 cutoff and still have a feasible operation, smaller but feasible operation. Thanks, Nick. I think that's.
Well, thank you, Ian.
You got that? Yep.
So if we look at how we might mine it, the first thing we did, of course, was look at what an open pit mine might look at. And here's the pit shells of a 20 million tonne per annum pits. You can see we have three pits, well, two main pits, Kaiser and Boda, and then we just touch some of the higher graded surface in Boda 2, 3. So these pits, we assumed that we would use a 600 tonne excavator and 200 tonne trucks. Obviously, there are other options available, some of which may be more economic that we can investigate. These designs are based on whittle shells. We didn't schedule it within an inch of its life, so we looked at whittle shells and how that would be broadly sequenced. And so there is potential to improve mining costs, and there's also potential for large underground bulk tonnage. Only about 25% of the resource has been mined in this concept study that we have. We put an underground under here. We looked at long hole open stoping. The reason we looked at that was we were trying to think, is this the kind of thing that we could start at a 5 million tonne per annum? Certainly one of the things that we'll look at going forward is how might a sub-level or block cave fit under here and obviously mine a lot more of the resource. Plant schematic, look, I just encourage you to look at that within the scoping study itself. There's nothing remarkable about this. You can see the HPGR and ball mill circuit, the flotation circuit, and then this is a traditional leach elution circuit. So very, very standard plant. This is what it might look like laid out. You can see that we would have two dual trains of processing. This is what a 20 million tonne per annum would look like. Basically, two trains of nearly everything going all the way through. And you can see that this doesn't occupy a massive space because, even though it's 20 million tonnes per annum, there's not a lot of processing complexity going to it. And it was this schematic that we used for engineering pricing. If you look at it, we developed all these recoveries from test work. The average copper recovery ended up being 83.5% and 73.6% for gold. That's total resource in the studies. It's a little bit different across the others, but points of percent. The main reason why that's slightly lower is because then the individual ones that we have for Boda and Kaiser is because when you mine an open cut resource, you also include other mineralized material, and that other mineralized material has a lower recovery. So that pulls that overall recovery down. We assumed payment terms for the concentrate. So this is otherwise not, some people refer to this as payabilities of 96.5% of the copper within the concentrate, or 97.5% of the gold within the concentrate. Obviously, you get 100% paid of the doré. And we had TCRCs of 50.05 cents. And there's a lot of debate about what numbers you can choose. Historically, $80.08, but at the moment it's zero. So it's really, an arbitrary number that other people can put into their own model. We think this is a very reasonable assumption, and these payment terms are very standard. The concentrate's excellent quality. What this means is we should readily be able to sell this, get good terms, and people may well wish to blend it. This is the 20 million tonne per annum scenario. You can see the saleable products, gold and copper. The gold rises and falls basically depending on which pit we're mining out of Boda and Kaiser. Each one has more or less gold than the other. And the really interesting thing to note is, and just to comment on that is, this is 17 years predominantly driven by the open cuts with the costings that we had. We actually finish open cut mining in year 13, and then we run out stockpiles. One of the main questions you ask, well, why on earth did you do that? Well, the reason is that it's cheaper to stockpile the lower grade material and then run that out without a mining team or mining costs or anything than it is to slow down your mining productivity and run it across the entire period of time as one site. That's why that's done. Logically, you would be looking to put a sub-level cave or other kind of, satellite deposits, and then we'll talk about the potential for those to continue the mine going, because you've spent, the better part of $2 billion on infrastructure. So operating costs, these costs are pretty middle of the road. They're certainly achieved overseas, and the other studies that have been done within Australia have lower costs than these in some areas. So we think these are pretty reasonable costs. We've got $3.30 a tonne for total material, ends up being $9 a tonne for ore mined, which is pretty standard. The processing costs, the big driver in here is electricity. We've assumed electricity at 10 cents a kilowatt hour. Current spot price in New South Wales is 17 cents a kilowatt hour. A lot of work occurring, a lot of forecasting has over through 2030 that price coming off. Certainly some of the solar pricing that you can get in New South Wales, if you lock it in, is at or below the 10 cents. So that's why we've assumed 10 cents a kilowatt hour, and maintenance costs have been assumed at 3%. So And in the sensitivity, we can show you how sensitive it is to electricity, and we'll talk through that. So pretty standard. G&A, full site, you can see $1 per tonne milled. So we have tried to really look at, well, what are the costs? How does it reflect for Tomingley, etc.? I think these are a reasonable cost base. Capital costs, and I really want to dive into this a little. These are simply presented at exchange rates and everything as of this year, March this year. And so that's the base for cost. Clearly, stuff will change going forward with time, but this is to enable decision-making to occur now. The actual plant component itself, depending on size, 500, 850, 1300, that's pretty normal. And you see other costs, reflected other projects and people. So that's done. Jumbo GR engineering services, quite a detailed level, so we're quite comfortable with those. I really want to dive into these because a lot of people are like, well, how did 1.3 become 1.8 billion? Obviously, there's a contingency in there, but the thing to understand is these costs are pretty similar amongst each option, which is why there is economies of scale based on the throughput. But for roads and power, you have to build that regardless. Right, so we have to upgrade the road going from Wellington out to the mine, and you have to install off the high voltage network. You have to run lines in. You need to purchase, depending on the size, the properties that underlie. You have to do biodiversity offset. You have to put a rehabilitation bond in place. This just shows the increasing footprint, particularly for the tailings dam. You obviously have to run water in, and there's a lot of decent water options in the region, in the pipeline. The residue storage facility, we're lucky in that the design we did, we just looked at, well, where might this go? We picked a typical style of location. Obviously, there's a lot of work that needs to be done as to determine a final location that would be worked through in feasibility. This would be a lined dam, and the reason which is part of the expense, and the reason it would be lined is to increase water recovery, because water is critical. So you want maximum water recycling, and you also want to capture any rainfall on the tailings dam effectively. Mining infrastructure is reasonably cheap, and the owner's team costs are also nothing remarkable. So that is how the costs were built up. So you can see there's quite a large portion of actual costs involved in getting a project. So certainly I would encourage anyone who's looking to compare to other projects. A lot of people refer to this amount plus a contingency, but there is a lot of other work that goes on behind the background in order to get a project off the ground. On the infrastructure context, I touched on this already, but it's really important to understand just how simple that this is in terms of mining operations. This isn't high up in the Atacama Desert. This isn't in the tundras of Canada. This is right next to major regional centres, particularly Dubbo and Wellington. Dubbo over 40,000 people. Wellington, half the size. There's power, there's water, there's a rail network. Orange is 110k to the south. Dubbo, Orange and Parks service major mining equipment. So this is a very, very good location. And it's on regional farmland setting. There's nothing remarkable about the environment in which it's in. So the key outcomes of the study, I've touched through these. I just want to draw out a couple more highlights. You know, these tables are available for everybody. I think one of the key things I want to point out is the total equivalent ounces produced in the large. This is just under 4 million ounces equivalent. If you look at our resource, this is what I meant. Like, the resource holds nearly 15 million ounces equivalent in it. So hence potential for large bulk underground mining. If you look at sustaining capital, that's a percentage of the installed capital, pretty traditional stuff. There's not a lot of work to be done on the tailings storage facility because we anticipate a lot of the waste going to the tailings storage facility. The two different cost bases, it really depends on, if you just make copper, sell the copper as if it were gold, so basically you're dividing the money that you've sold copper for into gold ounces, then you get a gold equivalent cost, about $1,900 an ounce, or $630 with a byproduct credit, like I explained before. And then last but not least, we chose an NPV 7%. And so you get a reasonable internal rate of return at current prices. This is a sensitivity based off the 20 million tonne per annum NPV. So NPV on the bottom. You can see, of course, it's incredibly sensitive to copper and gold price. So if we think, well, where are these prices going to be in the future? Everyone will have a view, but this gives you an idea. It is by far and away what it is most sensitive to. There's work to be done on gold and copper recovery because clearly they drive the revenue line. Less relevant is OPEX, and this is electricity as a component of the OPEX. And these are some of the opportunities that might exist with reducing mining costs. And it's much less sensitive to capital costs, as is often the case with large, long-dated projects. So what are we thinking about this as a company? Well, it's clear that, look, this is economically attractive at current prices. So it comes down to, well, what do you think the future prices are going to be? It's clear that the economies of scale are very important. In fact, more important than we originally had hoped. We had hoped that it would be possible to develop a 5 million tonne per annum and then go sort of 5, 10, 20. But it looks like the economies of scale overwhelm even the higher grade material that we can mine at the start, particularly when you compare that to the fixed capital costs that we'd looked at. It's very clear that we need to look at underground bulk mining in order to maximise resource recovery, which will be something we do in the coming year. And there's a substantial cost in non-processing capital, but that can't be avoided. So we have to do other things that focus on increasing the economics. And there's further opportunities to de-risk, which I'll talk about in the upcoming work. Ongoing optimisation, this is de-risking. I've talked about the need for underground bulk mining study, so that's fair enough. There is potential to reduce mining costs through automation, in particular in the open cut environment, and because that would be also included in an underground environment, so we'll examine those things. There's not as much urgency on that as understanding what a sub-level or block cave might look like. There is potential to do further work on the recoveries, which is just going to be a natural part of the feasibilities progressing. And of course, most importantly, there's a lot of exploration opportunity. And I'd like to throw back to Ian to talk a little. We have put in a recent announcement out about some of the work we're doing, but to talk a little about our views on that.
Yeah, thanks, Nick. So on the plan, you can see on the right-hand side, in the bottom right-hand corner of Kaiser and Boda system that you can see quite clearly there. And what we've known, or what we've learnt over the last 4 years of intensive exploration, is we understand the mechanisms of these porphyry deposits, how they form, what rock types they're associated with, what are the surface expressions are like. And for example, Boda, basically the system barely tops out at the surface, but Kaiser's a much deeper part of the system. So we've got a good example of a system that's well exposed like Kaiser to something that's a bit more subtle like Boda. So it gives us an idea. Traditionally, there's been other exploration through the region by companies over probably a 30, 40-year period. And to finish it off for us, we've just recently completed a detailed gravity survey over the whole project area. And that has helped us become more precise in our location. And a couple of the key areas that came out in the central part of the thing we call the Comabella intrusive complex, a large graben or caldera type structure. And it's interesting that the best mineralisation that we have now from our own drilling and regional drilling are at Drill Creek at the south end there, then Glen Hollow, and then Haddington to the north. So, for example, I think there was a drill hole here that goes back to previous things like in Glen Hollow. There's an intersection there, goes back to 2003 by another company. 18 metres at 0.95 gold and 0.15% copper. So and it was very similar alteration system to what we're seeing at Boda-Kaiser. That area has never been followed up. And similarly at Drill Creek, we've just recently put in some holes there ourselves. One hole got 130 metres of 0.25 gold and 0.1 copper. That was still in mineralisation at the bottom of the hole because it was an RC hole. And I think it just demonstrates that there's a tremendous amount of potential in the province. And what you're looking at there is a corridor, a structural corridor, about 15 kilometres long, stretching from Boda in the south right up through to a prospect called Murga in the northwest. And that structural corridor is certainly the hosting or the focus for a lot of these porphyry style mineralisation. So a lot of work that can be done. And even in Boda-Kaiser, particularly Boda, there are other zones inside Boda and Boda extensions to the south that we just haven't pursued in great detail at this time. Thanks, Nick.
Then, if we look, people ask, well, what's potential project timeline? Well, let's look at what the approvals requirements are. Environmental studies that are going to be used for an environmental impact statement for project assessment in New South Wales require at least 2 years of baseline data. So we're in the process of starting that collection of those different things. They're things like noise, dust, flora and fauna studies, what type of woodlands and all that kind of stuff is required. So there's 2 years required to collect that baseline data. Obviously, prepare and do other things in parallel to that. Then the project approval typically takes 1 to 2 years for metalliferous projects in New South Wales. Our Tomingley project, a bit over a year. Regis, a bit over 3 years. And, Regis at the moment is still requiring federal government approval. So if we call that 2 years as well, right? So that's 4 years. The federal approvals are typically done in parallel. So, when Alkane got the Dubbo project approved, that was done in parallel. But certainly for Regis, that's ended up adding a subsequent timeline to them. So there's potentially another year involved in that. And then construction duration of a large build, not particularly complex, it's another 2 years. So we are talking 6 to 7 years before this would be in production were it to be fast tracked. So people need to keep that in mind when they look at what's particularly potential commodity price going into the future. Strategic partnering, clearly developing a project of this scale, a large one with a larger partner, makes a lot of sense. The next stage of our expenditure, we're spending the better part of $5 to $6 million on exploration, and the studies that we're referring to, environmental studies, are not particularly expensive, hundreds of thousands of dollars in total. So that's funded already. That's already in our forecasts and our budgets. We see that there's a lot of value to be gained by continuing to de-risk. So where exactly are we going to get the water from? We've got some pretty good ideas, but where exactly and how do we get that permitted? Where exactly do we think we'll end up putting the process plant, and then what is the environmental impact of that? And let's progress that through into approvals. So we'll continue to work on that because that's going to be work going to need to be done by everybody. And so successfully completing that de-risks the project and therefore brings value. There is no short-term requirement for us to therefore embark on a formal process. However, we've had approaches from many different companies over time, just technically interested, as well as trying to understand. And by putting out this scoping study, we allow them to wrap a value around it as well. They'll either agree or disagree or have different ideas or pricing and all that kind of thing. So a lot of those people will be re-engaging with in the coming months and then progressing by mutual agreement. So the kind of things that we'd readily agree to is, people that want to come and look at a core, people that want to come and have a look at things, of course, we agree with that and then engage. So we'll be reinitiating that process. Now we put out the scoping study. We've got quite a few people that want to catch up after the scoping study and as to what their interests are, we'll wait and see. And that is the end. Thank you, Nicola, and we'll take some questions.
Thank you, Nick. Thank you for the update to both of you. We'll now move on to our Q&A session. The first question, and you've just briefly touched on this, will you seek to introduce a partner to help to fund the capex associated with the concept of mining and processing the 20 million tonnes of ore per annum, or will you be able to self-fund the development to produce this quantity yourself?
So current thinking would be that we'd look to introduce a partner. I mean, there's a couple of reasons that a partner adds value. The first one is the journey across to that point. So let's call that a 7-year journey. So there's some degree of money that has to go out in front. There's, road, power, water, property, things that need to occur. So, a partner would assist in that. That said, as a company, we look to continue to grow and develop. And so, of course, where we define ourselves in the position where we put adequate growth in place such that it wasn't such a large bite or requirement for us, then we may consider developing it ourselves. But certainly we think a partnering process, someone that brings not just capital, but brings, expertise, particularly at some of the things like sub-level caving, you can hire those skills. It would be beneficial to have a partner who is familiar with that.
Thank you, Nick. Our next question, will Alkane need to raise capital over the next 24 months?
To execute the plans that I've just described, no, we don't. So, when I talked about the Tomingley 5-year plan a week or two ago, I just sort of detailed that we're looking to increase our debt to execute Tomingley, so no. But that said, right, of course we would raise capital if we thought there was a purpose that would create value for shareholders, whether it was corporate activity or if Ian's team discovers something at Drill Creek that we think warrants a rapid drill out. That's, our drill outs have typically cost $20 million. So, we may go to the capital market for that, but there's no current plans.
Okay, our next question. Why did Alkane not include the rest of the underground resource into the scoping study mining plan?
I think I've addressed that. The main reason, just to recap, the main reason was we're looking to do a long hole open stoping solution that we thought we ourselves could develop in a shorter time frame, and that whilst that would work and that would be quite a successful little underground mine that will produce a couple 100,000 ounces, that's not what we were looking for. And so now we'll look to see whether we can do a sub-level caving. So absolutely, the person asking that question is correct. There's plenty of resource left underground, and we would look to include that in future feasibilities.
Thanks, Nick. As Alkane continues to expand into new ventures, which will require more capital, will this diminish the likelihood of the company ever paying dividend within the near, medium or long term?
So I think I said in the Tomingley 5-year plan update, we're not going to be in a position as a company due to the investment at Tomingley to be declaring any kind of dividend until FY26. So we'll reevaluate that close to the event. I think philosophically, to repeat what I said then, philosophically, we are a junior explorer who seeks to try and make multiples of value through capital uplift. So yes, we find ourselves very flush with cash, then of course we'll be looking at a dividend, but we're specifically looking to try and grow with success through, particularly exploration.
Thanks, Nick. Our next question. Can you please outline where and when Alkane will explore as to potentially increase the reserve and grade?
Ian, I might throw to Ian. We've already sort of outlined that exploration in the Drill Creek area, but Ian, is there anything more you want to add that we haven't already discussed?
I think just the opportunity to explain again in the detailed drill out of Boda and Kaiser, we understood over time, over a 3-year exercise, especially at 50-metre line spacing, where the high-grade zones are within the system. And some of those high-grade systems certainly haven't been explored at great detail. So yes, they could be filled in. But the reason that we didn't do it at this stage is because we felt we wanted to progress to some kind of a scoping study, but also most of those untested high-grade zones are quite deep, sub 800 metres. So yes, long-term strategy, it'd be great to have them and great to have them in the model. but at this point in time, it's not really a priority.
Thank you, Ian. Our next question. Can you please talk about the permitting process in a little more detail, specifically in relation to water, which is obviously a bit of a talking point in the region? Considering the size of your proposed mill, how do you think this larger water requirement will impact the timeframe?
Yeah, certainly. So within the scoping study, we can see that if we were to do 20 million tonnes per annum, then we're seeking of the order of 3 gigalitres of water. So, if we look at when we had the Dubbo project approved, that was seeking sort of 2.5 gigalitres of water, and at Tomingley we have basically licenses for 1.4 gigalitres of water. So this is per annum, the extraction per annum. So certainly, the size and scale that we're talking about, a lot of the water balance depends on the amount of rainfall in a given year. And so there's different licenses that we need. So we've got, harvesting licenses as well as extraction licenses. There's river extraction licenses from the quarry. There's fractured rock aquifer licenses. All these things are readily tradable and understood. So it becomes a matter of balancing the capital requirement to pay for those licenses in advance versus the type of the type of license that you need. So to talk more specifically, because of its location, it is an area with some degree of aquifer water. It is quite close to the Macquarie. It is quite close to people that have water licenses for sale. And there's also opportunities well to the east in terms of there are some brackish water sources to the east. So, these are things to examine in more detail with feasibility, but certainly I don't see the water as being the longest approval issue. I think the longest it's just one of a whole series of issues that are required. I think the big thing that will be examined mostly in approvals will be, the impact on the landscape that comes with mining.
Thank you, Nick. Our next question. Can you translate the current equivalent power prices into your sensitivity table, i.e. the budget was 10 cents per kilowatt per hour. We're currently at 17 cents. What's the impact of 17 cents power on NPV?
So the impact of the easiest way to answer that would be to say that on the $20 million the 20 million tonne per annum rate, we have, I'm just pulling up on my screen adjacent to me so that I can refer to them. So if we looked at plus or minus 10% electricity, and people can go to the sensitivity contained within the scoping study, then so moving from 10 cents to 11 cents, right? So plus or minus 10%, so 10 cents to 11 cents, took the NPV, moved, some sort of 1.81 down to 1.75, right? So 17 cents, basically, it adds roughly $2 per tonne processed, okay? So that is, circa $40 million per year less revenue, increased cost.
Thank you, Nick. Our next question. Can you confirm that Alkane will stick to gold exploration and production rather than investments such as Calidus, which was costly to shareholders?
Oh, no, I can't confirm that at all. The reason for that is that I think it's very easy to focus on Calidus, a little like Adam Simpson and the Eagles, won a premiership and has now been dismissed. It's very easy to focus on those losses. So whoever's asked that question would do well to reflect on both Explorum and Genesis, where the net proceeds of Explorum just under $1 million, the net proceeds of Genesis net over $55 million. Right, so here we are with the negative that we find ourselves in Calidus, assuming that it runs its course and shareholders get no money. So we still believe that a multi-mine company presents less risk to shareholders, can ride out commodity and mine staging and development differently, and we would still like to bring that about. And so if you look at Boda's a 7 to 10 year prospect, right? So in the short to medium term, no, that's not going to be something that can bring us a second asset. So that will have to be via corporate activity, and we continue to look and do that. And we'll continue to do so. So we don't make these things to try and do an investment. We make these things to try and merge and or develop and or take over another company, or come together in some manner so that we can decrease risk and increase returns for shareholders. Think if Calidus had worked, it hasn't, right? But if it has and we had merged, then it would be producing cash flow at the same time as we would be not needing to draw debt going forward at Alkane for Tomingley. So no, we absolutely will keep on the lookout for things.
Thank you for addressing that question, Nick. Our next question, what is the maximum annual volume you could produce from underground using long hole stoping?
Well, I mean, obviously, it depends on the ore body, of course, right? So it depends on the ounces per vertical meter and the ore body. For us, Boda-Kaiser, it's nearly 12,000 ounces equivalent per vertical meter, right, in the upper parts of the ore body. So if you just look at Tomingley, 1.2 million tonnes per annum, Cannington, 3 million tonnes per annum, Olympic Dam, 10 million tonnes per annum from long hole open stoping. It depends on the size and scale of the stopes that you can set off at once. So it really depends on the ore body. For us, where long hole open stoping has a nominal cost for us of $80 a tonne, we could not string together sufficient grade underground to carry that cost base. That said, you look at something closer to Cadia like with a block cave, $15 a tonne underground mining costs, and there's plenty of examples around the world. So that is why a bulk mining method's there. But certainly physically, people can do large long hole open stope mines. It's just it needs an ore body to support it with the mineral continuity.
Thank you, Nick. Our next question, what are the near-term plans for exploration at and around Boda-Kaiser? What is the budget for this work and what is it designed to achieve?
I think we've probably addressed that question, but just to be clear, the budget for the group's exploration over the next year or two is $5 to $6 million a year. Any worthy to add that we haven't already spoken about?
I hope we've covered it. I mean, there is two strategies as far as the project here is concerned. Is Boda-Kaiser itself, and I've said that really there's not a short-term priority there. The other part of the priority is things like Drill Creek, Haddington, Comabella, those sort of areas, which do have significant exploration upside, but you can't say you'd want to go in there today and commit $3 or $4 million. You really basically do staged exploration to build up the knowledge and build up the target potential. So we would probably focus in the next 12 months on things like Drill Creek and Haddington and Comabella.
To be clear, what are we trying to achieve? So we have millions and millions of tonnes of ore at an economic grade at surface, and most likely underground as well if we do a bulk method. So what are we after? We're after things of higher grade or slightly higher grade from open cut, right? So we continue to put in drilling to try and identify those things. We don't need to get another 1 billion tonnes in a large porphyry that's slightly lower grade, even though that would form year 30 to 40 of a operation at present.
Thank you to you both. This is our final question for today. Does the $400 million takeover of Rex Minerals, which owns a large, long-life, underdeveloped copper and gold asset in South Australia, provide a valuation metric which is useful as a yardstick for Boda-Kaiser?
I mean, I think so. I mean, obviously, a lot of analysts will put their thinking into this. I mean, there's different ways to value Boda-Kaiser. There's is it just $1 per resource ounce, $1 per reserve ounce? Is it a future NPV discounted for the stage that it's at? And everyone will have a different view. I think what Rex, and remember Rex was taken over by Mac Energy, spelled with M-A-C-H, who traditionally were coal mining business, right? Who found themselves, on my read of it, and forgive me if people think I'm incorrect, but are looking to diversify metalliferously away from coal, right? So that's a new entrant to the market that we hadn't previously seen. Like we've previously seen your BHP taking over Oz and others like that, or large gold companies seeking to increase their copper credits. I think what it shows is that there is a tension in the investment community and mining community around when to try and secure, control, invest in, partner in assets that contain copper, particularly if there's upside on the copper, even if they're not, tier 1, 200,000 tonne per annum copper deposits. So it's not so much that I think it provides a valuation point, but I think it shows the investment mindset shifting, and it gives us a degree of optimism that even though we don't need one, that a partnering process could be a productive thing in the coming period.
Thank you, Nick. This does cover the majority of questions from our audience today. If you do have any additional questions for the Alkane team, please email them to info@corporatestorytime.com. Nick and Ian, do you have any final comments?
The only comment that I will make is I think people should understand that deposits like Boda-Kaiser in jurisdictions where you have security of ownership, the capacity for long-term tenure, they're relatively easy to develop. Once you've got approval to develop them, they're quite rare. And then when they come in, they become generational assets. They run for years and years and years, because in real terms, we find that commodity prices tend to support that, and that's what occurred. So I think people should be very encouraged. And remember, this is a scoping study. It's to help us determine what are the paths forward. It's not to say this is our plan and this is what we're going to build. It's to help us determine what the path forward. And we're very encouraged with the value that we're seeing in the path forward.
Can I quickly add, Nicola? And Nick stole my thunder, but he probably put it more eloquently than I could have. Obviously, when we started to understand what we had at Boda, we looked globally, trying to do analogies. And obviously, the nearest analogy was Cadia. The more we drilled into Boda, the more we realised it was something different to Cadia. It's not an exact example, but there are many other examples in places like British Columbia, which are closer to the Boda-Kaiser model that we see. And what really encouraged me is that those deposits, which are probably similar grades to Boda-Kaiser, are actually in operation. And as Nick said, they're in an environment, an operating environment, which is far more difficult than, say, in Central West New South Wales.
I thank you both and the Alkane team for the update today. This does conclude our webinar, and I thank you all for your attendance. Thanks, Nick. Thanks, Ian.